Stop thinking Nvidia is just a chip company. Seriously, if you believe Nvidia's future depends solely on selling GPUs, you haven't been watching what they're doing in finance. Here is the counterintuitive truth that every AI investor needs to understand. Nvidia just became a bank. Not literally, but they're leading the largest AI infrastructure financing initiative in history, $500 billion in third-party capital. Goldman Sachs secured the coveted role as the sole lender on the deal, alongside alternative asset giants Blackstone, Apollo, BlackRock, Brookfield, and KKR. The twist: this is not vendor financing, where Nvidia would guarantee the debt. Bank of America analyst Vivek Arya calls it a pivot away from vendor financing. Nvidia can backstop up to $125 billion, or 25%. The burden sits with the consortium, not Nvidia's balance sheet. The goal: turn AI compute into an asset-backed market, where debt trades like traditional securities. Let me break down the deal, Goldman's role, and why this is a game changer. I'll admit something: when I heard Nvidia and $500 billion financing in the same sentence, I thought, this is vendor financing. Then I read the structure, and I realized, this is completely different. Today, I'm going to break down the entire deal. By the end, you will understand why Wall Street is calling this a new asset class. Let's start with the deal itself. The announcement, August 10, 2026. The partners: Goldman Sachs, Blackstone, Apollo, BlackRock, Brookfield, and KKR. Goldman's role: the only bank among the six, and the sole lender. The target: deploy over $500 billion in third-party capital for AI infrastructure. The method: multiple independent platforms that Nvidia's customers can tap for financing. The context: the top four hyperscalers are planning to spend more than $5 trillion by 2030 on technology and data centers. That scale requires private capital. The comparison: earlier AI infrastructure deals depended heavily on vendor guarantees, like Broadcom's residual value guarantee on roughly $30 billion for Anthropic. This is different. Now let me explain the structure. The old model, vendor financing, means the chipmaker guarantees the debt. If the customer fails, the chipmaker takes the hit. This new model is asset-backed. The consortium takes the risk, not Nvidia's balance sheet. Nvidia can backstop up to 25% of the deals, which is $125 billion. The goal is to create a tradable asset-backed market for AI compute. Jensen Huang's vision: they are bringing together the world's leading long-duration capital providers to independently finance AI infrastructure. The comparison: just as mortgages were once bundled into securities, the plan is to package data center machines into instruments that behave like bonds, with a secondary market. Bank of America analyst Vivek Arya says this appears to be a pivot away from vendor financing. The burden sits with the consortium, not Nvidia's balance sheet. Now let me explain why Goldman got the role. The history: in 2019, Goldman served as exclusive financial advisor on Nvidia's $6.9 billion acquisition of Mellanox Technologies. In June 2026, they were the lead underwriter on Nvidia's $25 billion bond sale. And they've done countless tech financing deals where Nvidia was an investor. The relationship goes to the top. Less than 2 years ago, Goldman CEO David Solomon interviewed Jensen Huang at a Goldman-hosted tech conference. Jensen came to Goldman. Jensen came, approached us with the idea, and we said we'd love to talk to you about it, Solomon told CNBC. Goldman's multi-pronged role: their asset management provides junior capital and private credit financing. Their investment bank places debt into private credit funds and eventually public debt markets. The counterintuitive truth: Goldman isn't just a participant. They're the architect. Now let me explain the big picture. The goal: turn AI compute into an asset-backed market. How it works: just as mortgages were securitized, Nvidia wants to package AI data center infrastructure into debt instruments that can be bought and sold. Why this matters: lower funding costs mean a liquid secondary market leads to lower interest rates for borrowers. Broader investor pool means insurers, pensions, and sovereign wealth funds can participate. Scalability means the $500 billion target could grow. The investor base. Goldman is talking to US insurers, money managers, banks, asset managers, and private credit firms. The asset-backed logic, compute that is fungible and transferable across operators, with CUDA continuously extending useful life, keeps resale and rental rates high and depreciation curves benign, BofA wrote. Let me leave you with the 3 secrets that connect everything we just discussed. Secret 1. The pivot away from vendor financing trap. Investors feared Nvidia was over-leveraging their balance sheet. This structure puts the burden on the consortium. Nvidia's risk is capped at 25%. Secret 2. The asset-backed AI compute vision. Nvidia wants AI data centers to trade like bonds. Lower funding costs, broader investors, scalable growth. Secret 3. The Goldman moats advantage. Goldman's relationship with Nvidia is deep. Mellanox, the bond sale, and now this. This is a recurring revenue stream for Goldman, not a one-off deal. So what should you actually do with this information? If you own Nvidia stock, the financing deal removes a major risk, balance sheet strain. This could support Nvidia's long-term growth without diluting shareholders. If you are a financial investor, the 6 firms, BlackRock, Blackstone, Apollo, Brookfield, KKR, and Goldman, are positioned to benefit from the AI financing boom. If you are a trader, the asset management firms rallied on the announcement. Tech stocks sold off. The market is still digesting what this means. Watch for more details on the actual structure. Here is my question for you. Do you think securitizing AI compute is brilliant financial engineering, or a bubble waiting to pop? Drop your answer in the comments. I read every single one. Like and subscribe if you want more analysis on AI infrastructure and the companies shaping the industry. I'll see you in the next video.